make the whole trade smaller. But Katie, let's get into today's segment. Iron condors on futures options. This is one that I think is going to hopefully have a lot of crossover with people who are used to iron condors on stock options. But I wanted to highlight this strategy and in this derivative space, Katie, because I get this question a lot, and I'm sure you do too, which is like, I've traded iron condors on Apple or, S&P 500 ETF or what have you. What do I do now that it's on futures options? It's actually kind of similar to, it's snowing here in Chicago today, and I drive really well in almost any day of the year. Snow falls, and a lot of people are like, what happened? Does the green light, does it mean go or stop? I don't remember anymore. And which isn't to belittle this, because obviously snow can be a big deal. Futures options can be different than stock options. But this is all to say that like everything is pretty much the same, whether you're on the road and it's snowing or not, or you're in iron condors on stock options or futures options, right, Katie?
Yep, agreed. Yeah, the translation, if you've dabbled in any type of stock or option strategy using stocks or ETFs or whatever, translates super well. All the main pillars that we discuss day in and day out are 99.9% the same.
Exactly right. And with that being said, let's do this from A to Z here. Iron condors allowing you to take a neutral stance on a market with defined risk. And this actually might be, I go back and forth with like, when people are like, I'm trying to get my feet wet, my hands dirty in derivatives. What should I do first? Like, what should be the go-to thing? And this actually might be it, because one, you don't have to have a bias on a market going higher or lower. In fact, you're trying to profit. If you're selling the iron condor, you're trying to profit from the market staying still. If you're buying it, then you're trying to profit from the market just moving a lot in either direction, and it's defined risk. And so the risk that I have, which is going to be the width of the spread minus the credit. Say I sell an iron condor, the spreads are $5 wide and I sell it for $1. My risk is $4 if the market goes to 1 million or the market goes to 0. Do you think this is the go-to starter strategy?
Honestly, I do, just because of the things that you mentioned. But to me, I didn't go to school for trading or finance or anything like that. So I thought you had to be directional. So this was like super eye-opening to me, that I didn't have to make a choice and I could actually still participate without having to be so polarizing, I guess is the right word. This to this day is probably the most used strategy that I use.
That's actually, we don't harp on that enough, which is like, that was one of the biggest epiphanies probably in my education, my academic into practical work life, was like all of this different, oh my gosh, studying math and all these different things and theoreticals around, a market, probabilistic models and everything else. And then whether it's at school or in your practical life, it finally hits and someone's like, oh yeah, this strategy is super popular. It profits from the market not moving at all or the market moving a lot, and it doesn't matter which direction. It's really, really cool. And it's liberating in a way that might sound bad, where it's like not having an opinion is empowering in a sense.
Yeah, exactly. I totally agree.
And so let's look at how you would put this on with the new options on small exchange futures here, because you can look at long put, short call, long call, and that's going from lowest strikes to the highest strikes there for the short iron condor. And futures options, setting up the iron condors, exactly the same. You're just going to want to look at either however you want to cut it. There's a lot of different ways to visualize this: a short call spread and a short put spread, a short strangle that's closer to at the money, and a long strangle that's further from out the money. However you want to view this thing, I almost feel kind of bad putting together a segment like this. Almost the exact, it is the exact same thing, whether it is options on small metals futures or options on the gold ETF.
Right. Exactly. It's yeah, same thing.
It really is. And what's more important probably than the setup there, if you've ever traded an iron condor before in any of those other markets and you want to translate it to futures options, Katie, what I get the question more 9 times out of 10 around something like this is, do the mechanics translate? And how do you view the mechanics of setting up your iron condors in stock options or futures options?
Right. Yeah. There's a couple things here. Obviously, the one you have listed here, I'm going to get into in a second, but we've done so much research at Tasty Trade around entry mechanics, picking days to expiration, what we've found historically to be like the best bang for your buck when it comes to collecting enough premium, not tying up enough buying power for where it's like not fruitful anymore, but also being able to capitalize on that volatility decay or collapse is right around that 45-day time frame. So luckily, if you look at the SPRE futures options right now, we've got 2 different chains available for you if you want to go to that longer term 45-day expiration. You could also do something in the shorter time frame if you have a shorter term idea, but from the perspective of like what we're trying to talk about here, I would probably go to the 44-day expiration cycle. And then from there, it's what you had listed in that slide where you're picking 2 out of the money spreads. So an out of the money put spread and an out of the money call spread, depending on your directionality. But typically at Tasty Trade, we kind of start to put our short strikes at those 30 deltas. And then ideally, if all is working out in our favor, we're also hoping to collect around 1/3 the width of the strikes, if at all possible.
Yeah, and right here's your very basic vanilla setup for something like this. And though it's not a lot notionally, I think it's a good place for those starters out there to get in, which is the short strikes right there at the 30 delta on both sides. And you're looking at a trade that is only $84 in potential profit, but it's only risking $116 right there around the 1/3 the width of the spread, which is 80 cents relative to 2 full dollars. Mm-hmm. Or you can also look at it as I'm looking to make at least half of what I could lose. Right. That's another way to kind of envision that. And the last piece here, Katie, here's your nice setup. You can mess around with it. You can make it tighter. You can make it wider, the spreads and everything else. The last thing is the management. And it's the same thing that translates. If you want to roll it at, 20 to 30 days or whenever people look to roll, or even less, 15 days, what have you. Or if you're getting profits of 50%, you take that thing off for a 40 cents profit, the example that we just looked at, right?
Exactly. Yeah, that all of it applies. I mean, there was no deviation in anything we talked about. If you were to do the same exact thing in the GLD ETF, it translates over perfectly. Though the other thing here that's like also just useful is that in this example, where if you were doing this with the gold ETF, this example is not only peppering in gold, but it's also giving you exposure to silver and platinum too. Mm-hmm. So a little bit of a different basket of metals for you to kind of be speculating on, and still hoping for, this particular product, SPRE, to stay in a range over the next 44 days.
Yeah, that little piece there moves the volatility a little higher. Silver tends to move more than gold, which is nice. And yeah, the only real difference is that the futures here actually give you a lower buying power. You saw there that I was risking $120, but I was actually putting up less than $60 there to get that iron condor off, which is really, really nice. And so great piece here on iron condors in futures options. Katie, thanks so much for joining us on that. And if you don't know, everybody out there, and Katie, I'll put it in front of you because